Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. Three different topics: wealth building, commodities, and or financial topics. So let's dive in. Let's take a look, see what people are sharing. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, I dive into all of these topic subjects looking for potential investment opportunities, sharing all those opportunities with everyone in the community. And if that's something that interests you, definitely sign up, try it out. We do have a coupon code special. Special is that discount coupon code, and you can try it out on a monthly membership, 50% off the first month. And then if you want to sign up to a yearly membership, you can also get a larger discount. So silver long term, fractals just repeating over and over. So we had a downtrend into, we'll call it the early 40s bottom. We had a double bottom line coming across. We broke out of the double bottom, did a little retest. This is your ideal entry point for most technical analysis people in 1948, 1949. And then you just rode it all the way up. Ride, all the way up to 50. Now, from that point, being in silver, 65 cents or so, 70 cents, wherever it was, all the way to $50. That's all you really need. It's all you really needed back then. It's just silver. We went into a large consolidation from 1980, where we had a big cup and handle. We've got a double bottom here, which looks eerily similar to the double bottom here. So downtrend, double bottom, break of the downtrend up. That peaked in 2011. We went again in a similar fractal pattern, double bottom, with the line going across, breakout, retest. Your retest is here, your retest is there, your retest is there. And then we've just broken out away from that retest, moving on up. So I think we've got a long way to go with silver moving to the upside here. Looks really, really good from a long-term perspective. Now, does that mean that silver will go up immediately? It doesn't. So if it doesn't go up immediately, people will say, well, I thought it was bullish. It is bullish. You just need patience. Because there were times, if you look back here, that it went sideways for a while. And it went sideways for a good chunk of time. So this is more of an asset to protect yourself against currencies, debasement. It's another way to play the squeeze in silver as renewables, artificial intelligence, the increase of all of these electronic circuit boards and stuff like that, they all require silver. So it's a 1-2 combo punch of energy, like renewable energy in the future, AI and all that stuff, and the boards that come with it, the electrical conductivity that silver provides, and a monetary kicker. There's the 1-2 punch. Coming down. So let's read through this. The bull market in S&P 500 and tech will end at some point. My guess would be over the next few years, we will top. And I don't know for sure. We could be topping now. I just said, I patted it and said, you know what? Maybe the next few years we'll see a top for sure. We will then enter another commodity bull market, probably bigger than most can imagine today. Bitcoin crypto has only existed and been tested during the NASDAQ bull market since 2011 bottom. So a lot of people, everyone on Twitter, they're all gung-ho on crypto, and maybe rightfully so, but it's only existed in a bull market of the NASDAQ. So let me show you what I mean. And this is the S&P and NASDAQ. I chose NVIDIA Corporation. The commodity bull market from 99 to 2011, which was right here. This was your commodity bull market. And NVIDIA, technology stocks, S&P 500, they all went sideways there. They all went sideways. They consolidated. After that bull market, they went into a bull market. So tech and S&P 500 from 2011 onward was in a bull market. So Bitcoin has only existed in this bull market. It's never existed in a commodity bull market. The question I have is, can it survive a commodity bull market? If Nvidia were to pull back by 80 or 90% and crypto pull back to $1,000 or some ridiculous amount, could it survive? I don't know if it can. And they're not looking at the longer, bigger picture view here. Here's the commodity bull markets priced in the S&P 500. We had a commodity bull here where we went sideways in the S&P, another commodity bull here where we went sideways, and then we are going to see another commodity bull market somewhere, I think, coming up. Why do I think that's the case? Well, all of these, this one here, gold was revalued. So this was like government revaluing everything higher. This one here, I think, was a combination of peak oil in 1970 in America. The market went sideways, interest rates went up, inflation was rampant. We also had a lot of people buying homes, which increased the monetary lending. It was more money into the system, and we had a problem with energy delivery, which created a gigantic bull market in commodities, oil specifically, and gold and silver, because interest rates were just rocketing at that time. So that was the American top of oil. In 2000s, we had another peak. It was peak conventional oil in the world. At that time, we also had a housing boom. We were throwing money into the system at the same time that we hit peak oil in the world of conventional. Surprisingly, in 2010s, shale, unconventional oil, ramped dramatically. What I think is going to occur is that we are going to hit world peak oil at some point here, and it will be shale rolling over. And I think that will hit over the next few years, where we get a gap between oil production, which is supply of the world, and we're going to continue to dump money into the system from fiscal deficit spending. It's not coming from monetary bank lending necessarily. So that's what's going to expose it. And if we cannot increase the production of oil, I don't know what's going to bring us out of it. I don't, but it'll be interesting. Coming back, we've got bottom of the cycle for gold was 2000, and we are bottoming again against the S&P 500. Imagine the outperformance gold will have against the S&P 500 when the cycle changes again. So here's 2000, a massive outperformance of gold versus the S&P 500. I see a lot of people talking about the S&P. Oh, the S&P this, S&P that. Guys, gold is where you want to be. It has less risk, bigger upside potential, and it's already in a bull market since 2000. And apparently nobody they don't see this, apparently. So this is the S&P down here getting absolutely waxed by gold from 2000. Yes, I chose 2000 specifically because that was the bottom of the cycle. This is what it looks like when you price it against each other. It's a double bottom. Bottom one came up, and now we're at bottom two. Bottom two is similar to 99, 2000. We are going through that again. This is a peak of 1980. We were in a declining interest rate environment. The interest rate environment is changing into an increasing interest rate environment. This is why it fell. This was fully priced gold against the S&P. Declining interest rate environment, money shifts into the S&P 500. You got your double bottom, and we're at the bottom of the double bottom. This is the perfect time to be loading up on insurance for something bad to occur. Increasing interest rate environment is the driver of why people are going to move into gold. And that increasing interest rate environment is going to be driven by oil, just like the 1970s. That's your full circle. So here is investing with Brandon. The next recession is your biggest opportunity to get rich. Stop fearing corrections, start preparing. I think that's true. And I think commodities is where you want to be on a longer term, bigger picture view. It deals with the undervaluation in commodities. So that's why I'm looking at commodities, because of all these charts that you see, I tie it all together. It's not one chart or one thing. It's the undervaluation of precious metals and how they have performed under the conditions that I think are coming next. I'm not playing checkers, I'm playing chess. Stop loss concept is not my cup of tea. For example, if I'm bullish on a company at 800 and it goes down to 600, if the thesis remains the same, I would be inclined to buy more. How can I sell at 600, which is a 25% discount, to 800? In my view, in most cases, if researched properly, it is not stop loss. Rather, later on it would prove a stop profit. Yeah, agreed. And that's the difference between an investor and a trader. Traders, I hate to say it, guys, traders don't get rich. Like, they're almost all broke. There's very few people that trade that make a lot of money. There's very, very few. Majority of people who make a lot of money are people who are long-term investors. Jeff Bezos is a long-term investor in Amazon. Mark Zuckerberg's a long-term investor in Meta. All of those guys are long-term investors. All of them. Warren Buffett, Charlie Munger, Howard Marks, Peter Lynch. I don't know about Stanley Druckenmiller. Maybe, maybe not. But most of the really rich people, they made it off their own business, of high concentration, investing big in their own company, and then riding it for like 20, 30 years. So the stop loss thing, I think, is stupid. I really do think that's kind of stupid. Now, is there times where I lose money? There is, but that's the strategy and how you set up your portfolio. So I lose on a good chunk of my positions. That is correct, but I also massively win on a good chunk of them too. And the asymmetry is what carries me higher. Here's zero hedge. The first time in history when 100 bips of rate cuts raised 10-year yields by 100 bips. That is what I mean by a very weird dynamic going on in the market. And again, this is the first time in history. So you go and you look backwards at history, you're like, where else has this occurred? None. It's the first time in history where they lowered 100 bips and the 10-year went up 100. It's confusing. It's like, what's going on here? People are running away from bonds, is what that means. The joys of compounding. The key to wealth creation is to buy high quality, growing businesses at reasonable valuations and then just sit on them for a very long time. And that's all investing is. You buy really good companies. You're not going to pick the absolute bottom perfectly, and then you just sit on them for a long time. If you're in these companies that are good across many market conditions, that's what you do. You do exactly what that says. And then you hold them for like 20, 30, 40 years. That's literally what you do. Now, in commodity companies, you have to hold them when they're cheap and then ride it through the cycle and sell them at the top of the cycle. That's what you have to do. $1 invested in 1802 would turn into stocks 2.3 million, bonds 2,163, bills, gold, and dollar. Here's the problem with this, though. We were on a gold standard. So gold's not a legit, it's not a legit measuring stick. You have to start it from 1970 or 2000 or some other area. I started this one up here from 2000 where the cycle bottomed, and the S&P 500 got absolutely, smoked by gold. So his analysis or his comparison is not a legit comparison here. I see a lot of these comparisons. It's like, I'm not buying this because we were on a gold standard before, and stocks actually did quite well, even on a gold standard. The banks didn't like it, though, because they couldn't loan and make any money. So what they did is they went off the gold standard where they could basically their loans and try to make a whole bunch of money. If we use the official CPI figures and extrapolate from 1970, the median house price in the US should be $65,000. I'm not making this up. Yeah, it's the CPI. It's a completely jacked measurement. House prices are way higher, and the CPI is just a made up number. There's hedonic adjustments, substitutions. So perhaps they hedonically adjusted or substituted, saying, "Well, we used a 1970 median house price in 1970, but the person, since they can't afford to buy a house, well, we adjusted it where they're just renting a one-bedroom apartment." And now that costs $65,000 a year for a one-bedroom apartment. That's how stupid these numbers are. It's unbelievable how stupid these numbers are. They're just all made up, figures. Walter says, if you're honest, hardworking, reasonably intelligent, and have good common sense, you can do well in the investment field as long as you are not too greedy and don't get too emotional when things go against you, says Walter Slosh. And that's true. The best stimulus package would be a 0% income tax. Totally agree with that. David says, I'm going into 2025 with 4 positions. Tesla, HIMS, SQ, and AMD. All tech. I think they're all technology stocks. I'm not really sure what HIMS is, but AMD is, Tesla is, and SQ. I'm seeing a lot of the posts are very related to tech companies. And some of them, they do look all right. Their charts. But I think their valuations are pretty crappy, what I'll say. And I'm a big value guy. So Trend Spider, now that the valuation has finally come back down to earth, is Celsius a buy here? CELH, you can see the big volume of traded shares. It's creating a base there. This is funny. So he thinks that the valuations come down to earth at PE of 26, but look at this, 318, 248, 81, 258, 215. So it's a combination of their earnings increasing and then the stock price also coming way back down. I don't drink any of this stuff anymore. Like I used to drink it way back in the day. Not Celsius, but other stuff, but I wouldn't go into it, me personally. But I don't know. It does look like it's basing out, though. It's trying. There is a big bearish engulfing here. I'm not sure if it's completely done, but it could be close. Markets are rigged using derivatives. They buy what they want to go up. They sell what they want to go down, says Bill Holter. Merry Christmas. The derivatives market. So Matt Elf says, I follow you on YouTube. Here's a question. Who would be some of the top people you follow on X for timing cycles and investing? Well, I would say Grady's pretty good. Grady, I think, is one of the better people to follow. You could follow North Star Bad Charts. They have some big picture views on big picture charts on the S&P 500, gold, tech. Looking at all that stuff. I like Monish Pabrai. He's really good. He's on YouTube. He has a bunch of videos, training videos for investors. I think he is incredibly good. And for the cycles, David Murren, you could follow him on X here. You could listen to Michael Oliver. I think he's looking at the potential top of the S&P 500, Nasdaq. It's hard to call tops though. So I mean that's really where I would look. I wouldn't focus so much on timing the cycles perfectly. The cycle and how cheap those companies are is what you're looking for. So we are on a down cycle for commodities because of the valuations of commodities, and we are in a peak or bubble for the NASDAQ, crypto, and all that crap. And we are putting in bottoming patterns in the commodity sectors. We're putting in potential topping patterns for some of the areas, not all. So it could continue a little bit while longer. We have seen dramatic outperformance of commodities in relationship to tech stocks from 2020 bottom. So I do think we are in a commodity bull market. I do think they're going to outperform, but we've been in a sideways trading action, a consolidation. The sideways consolidation, people get frustrated in. They think, "Oh, this isn't a commodity super cycle." It's like, guys, you have no idea what's coming. you have no idea. And then they just chase price. They go run over back to crypto or some tech company chasing price performance. These big cycles take time, and you want to get your foot kind of in the door on them. You want to stay in it and just sit in it, do nothing. It's very hard for people to do that if they see people making money in a different sector. And then what they'll do is they'll go on Twitter and they'll start posting, charts that this company's or sector's outperforming a company or sector that I am in. But that doesn't mean in the short term that outperformance there doesn't mean that the cycle's turned. Doesn't mean that you want to be in those higher risk, not very good asymmetric opportunities. So they're just chasing price performance. They don't have a strategy. They don't have goals. And they're just running around chasing whatever goes up the most. I call them, they're squirrels running around for a nut. That's all they're doing. And they found a nut, and I'm waiting for the mother load of nuts to come, is what I'll say, in the commodity space, because that's where the valuations are very cheap. So your risk is a lot higher when you start to chase price irrespective of valuation. So the cycles, I didn't learn this from any person. I mean, if you really want to follow somebody, follow myself. Sign up to the website and I'll show you everything. Ask a ton of questions about these cycles. I will show you all the charts. I will show you what drove, real estate cycles, all that stuff. I can show you all of it. In fact, we have a bunch of videos on the website exactly what you're asking. And you can ask me directly. And I don't know if a lot of these other people know that the real estate cycle was a driver in the 1970s. Now it's more fiscal driven, and fiscal driven still means you have inflation. And what's going to expose it is going to be oil. And I hate to say it, but no one is positioned for that outcome. No one. I mean, I am, but there's very few people that are positioned for a problem. A lot of people think we've got 6 million barrels spare capacity. I would say it's probably closer to 4, but that's me. Maybe I just have a bullish mindset. We'll eat through that probably 25, 26. We'll see what occurs. 26 will be, it could be, depending on what shale does. If it rolls over, it's done. Like, that will be the spot to be. Not shale, but oil. Oil will be the spot to be if shale rolls over. And, there's speculation on if natural gas can grow a ton. We're putting in copious amounts of capacity for LNG takeaway capacity. We'll see what we got. I know there's a bunch up in Canada in terms of natural gas, but it's kind of landlocked in. So, again, we'll see. We'll see what occurs. But that's where I'm going to end it, guys. But give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We'll catch you guys, Sunday, 5 p.m. Mountain Time is when we have our next question and answer session. If you'd like to join, we do have a special going on. Special is the coupon code. Save 50% off the first month or get a larger discount on the yearly membership if you'd like to sign up for a year. But that's what I've got for today, guys. We'll catch you next time. This is Finding Value.